Hi, everyone. Dan Eisner here from ZLC Employee Benefit Solutions. My passion is working hard to find better ways for employee benefits by partnering with finance and HR leaders in the market. I also look to leverage my relatively unique profile with more than 20 years of experience as an employee benefits advisor and the skills as one of the only chartered professional accountants working in this industry in the local market. It's this passion that drove me to develop the Better Benefits podcast series, and thanks for joining me for another episode. I'd like to talk about an issue we encounter when it comes to negotiating annual employee benefits renewals. As you know, employee benefits costs continually go up, but the level of those increases are subject to insurers and their underwriters and the assumptions and methodologies they use. One of the most significant assumptions is the inflation trend factors used to calculate health and dental premium rates. So let's talk about that issue here today. As always, I'm going to give you my thoughts, but I'm really interested to know what you think. So let's get started. So, as an employee benefits advisor, I have the unfortunate duty to annually let my clients know about the costs of their employee benefits programs. And the reason I said unfortunate is that over my 20 plus years in the industry, I've yet to see a year where we saw overall deflation and rate reductions across the board. Sometimes I'm able to deliver a renewal with a decrease, but that's often related to a change in claiming patterns, plan design, rather than a broader market trend. Instead, we've seen actual inflation for extended health benefits run anywhere from a low of 4 to 5% between 2010 and 2015. And that was when the majority of brand name drugs in Canada lost their patent protection, to a high of around 15% around 2000. And that's when most provincial governments downloaded a lot of services onto private plans. But on average, over the last 20, 25 years, extended health plan inflation on average has run between 6 and 10% a year. The numbers referenced here are historical inflation levels, but the insurance industry for employee benefits is based around a concept called prospective rating. Essentially, the insurers, but also us as advisors, try to look in the crystal ball and project what the cost of claims will be in the coming year. Okay, and when we do that, we incorporate inflation and expense factors to determine what the premiums are needed to pay those claims. As such, all insurers develop their own trend factors to estimate future inflation. But the question is, do those factors actually resemble true inflation? From our recent experience, Canadian insurers are expecting extended health plan costs to increase by 10.5 to 12.5% for 2024, based on the trend factors that we're seeing in their renewal calculations. You note that these trend factors have remained relatively steady over the past decade with few small deviations. But how do those insurer trend factors, which they use to develop the rates, actually compare to real or projected inflation? So, as per the ZLC Employee Benefit Solutions inflation projection for 2024, we're projecting inflation for extended health plans to only be 6 to 10% for the coming year, which is a big difference from the costs that I just talked about that the carriers are projecting. So you may ask, what's going on here? Why the big differences, and what does it mean for you as a plan sponsor? Firstly, remember that these trend factors are used by insurers to develop their proposed rates. And these proposed rates should be subject to analysis, differences of opinion, and negotiations. Insurers may agree to negotiate lower rates depending on the arguments put forward by advisors working on behalf of plan sponsors. But based on our experience, they'll never, ever admit that their trend factors are overstated. They stand together as a group with small variations amongst themselves. As such, the underwriting strength of your advisor is vitally important. So why do insurers do this? I'd say it, the simple answer is profit, but they'll call it managing risk. If they develop and use overly conservative or higher trend factors, they develop higher proposed premium rates, and that's their revenue base. So that may sound like a reasonable business strategy to manage risk, but let's remember, insurance companies are already paid for the role of managing risk, and that's built into their expense and profit charges that are already in the premium rates. So these higher trend factors are more likely about padding the rates to insulate them against unforeseen volatility. But isn't that what they're meant to do as an insurance company in the first place? So, the intent of this podcast is not to vilify insurers or the broader insurance industry. Arguably, all businesses have differences in the margins that they charge to different customers, and that's essentially what insurers are doing here. Those plan sponsors that have a strong advisor in their corner can typically do better than the broader market and negotiate lower rates. To do so, advisors need to arm themselves with an equivalent level of underwriting skills, market data, and industry experience in order to speak the same language as the insurers and do battle on their terms. At ZLC Employee Benefit Solutions, we are very proud to have one of the most experienced advisory teams in BC, over 400 years of experience amongst our team of 20 specialists. More importantly, within that team, we have over 140 years of experience working within the insurance companies in leadership and underwriting roles. So our team has the experience working on the insurer side, but we also have experience working on the plan sponsor side of the business. As well, we have our own underwriting team, and we stay abreast of all industry issues impacting the underwriting of employee benefits plans. The plan sponsor, you need to have the right skills and expertise in your corner with the best advisor working on your behalf. Only then will you have the confidence that you're paying the right premiums for the plan and not padding the insurer's profit margins. Okay, heard my thoughts and opinions. Let me know what you think. Was this advice helpful? How does this compare to what you're hearing from your current advisor or other advisors that you've talked to in the market? As well, I'm always really interested to know if there are other current topics that you'd like to see me cover in future podcasts. Let me know what's bothering you or keeping you awake at night with respect to your employee benefits plan. Thanks for joining me today. Be sure to follow me on my LinkedIn business page, which is Dan Eisner, Employee Benefits Advisor, and you'll get notifications on the next Better Benefits podcast. All that information will come up on the screen in a second. Thanks so much.